Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Yoel Mayerfeld. Yoel is the co-CEO with Chase Properties, where he oversees the company's asset management and financing. Mr. Mayerfeld joined Chase Properties as the Director of Finance in 2005. And in just a minute, we're going to speak with Yoel about a winning investment in retail. While others have been quick to move away from the asset class, Chase has been thriving in retail. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help. You can like, share, and subscribe. And as always, we encourage our listeners to leave a comment. We love to hear from you. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Yoel. Welcome to CRE Radio.
Thanks for having me.
Well, I'm looking forward to our talk today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So my background was in finance, is where I started out after college. I was a derivatives trader for many years, really focusing on risk. And towards the end of that first career, I was running an exotics derivatives book for a bank, and was searching for my next career to be something much more tangible than exotics derivatives, that I had to rely on sort of Monte Carlo models to solve difficult hedging strategy ideas. So real estate was really what was attractive to me, because I could understand how to evaluate the risk reward for real estate. So about 18 years ago, I left New York with my wife, and we moved to Cleveland and joined Chase Properties, which historically had been a family capitalized retail real estate developer and acquirer, and have been there ever since.
Got it. I got to ask you real quick, derivatives, I know the word, but I don't know that I know what that entails. I mean, when you're trading for a fund, can you give just a quick description as to what that entails?
Sure. So it's really any financial instrument that is, a derivative of something else. So in my case, it was equity derivatives. So it's derivatives of stocks. So an option, like a call option or a put option or a swap, are primary examples of derivatives. And then certainly there are derivatives on commodities and fixed income. But what I spent time on was the equity markets. And for the first part of my career, mostly it was more vanilla structured calls, puts, swaps. And then the latter part, it became exotics, which are just much more complicated contracts between buyer and seller, that allow for different scenarios and different protection of risk, or ways to speculate on volatility, as an example.
Got it. Now, I've always kind of been fascinated how the big money wins in a market that's going up or down, and I'm assuming that a lot of the ability to win like that is to do with kind of what you were doing there, is the ability to kind of structure those opportunities.
Absolutely.
Yeah.
Absolutely. And I worked for banks
Right.
during my career. So our the other side of the trade was often hedge funds who doing exactly what you're talking about, where if they were volatility arbitrage hedge funds, they were buying that contract from me to do exactly what you're saying, find ways to make money regardless of the markets going up or down.
Got it. Got it. Well, I appreciate you sharing that. So you've been at Chase now since 2005,
Mhm.
and you mentioned that Chase, was it basically a family uh, run developer? Is that what I understood you to say?
Correct. We started nearly 40, not just under 50 years ago, developing retail shopping centers for Kmart. Really, Kmart was the anchor way back when we started, and ultimately for other anchors. And then probably about 20 years ago, we really transitioned when we saw that the country didn't really need any more retail, that there were enough opportunities in the existing retail to acquire good cash flowing shopping centers. We probably then we still developed in a smaller way, but moved more into an acquisition mode of finding value where maybe others didn't see value, based on our experience in smaller markets, which is where we've always thrived, even from our development days. So our focus has always been in secondary and tertiary markets. Um, I like to say the strong small markets. So we stay away from the real teeny tiny markets that maybe have less economic diversity. To examples of towns you probably heard of are like South Bend, Indiana is a market we love, or I'm based here in Cleveland, Worcester, Ohio, if you've heard of that market. But many of the markets you probably haven't heard of. Um, Smaller markets in Kentucky that are super strong, super stable, great trade areas, where we're able to find a retail hub and the best center in that retail hub in an isolated market where many counties come to our town, our retail center for their shopping.
Oh, I like it. Easier to be a big fish in a small pond than a little fish in a big pond kind of thing. Um, so the I guess the question I would have, territorial or the territory you guys operate in, is it primarily Midwest then, or do you guys how far out do you get?
Yeah, it has been primarily Midwest, whereas far west is Kansas. We've really been situated we look for centers in the Midwest, the Southeast, and the Northeast, but it's primarily been the Midwest and a little bit more of the Southeast as of late. We love the Carolinas. That's been probably over the last 10 years we've entered into the Carolinas. But the Midwest has really been our bread and butter for most of our existence.
Got it. So can you um, characterize the difference? And I say the difference because as of late, especially with COVID and the Amazon effect on retail, there's been a change that's occurred in retail as far as more of your metro uh, primary, secondary markets and that, as opposed to what you're experiencing in your tertiary and strong small markets.
So I want to make sure I understand the question right. Are you saying how are we experiencing the Amazon effect differently than maybe other retail
Yeah. Is
operators?
it affecting you similarly to, and I say this
Oh, I
having
got it.
interviewed other people about retail and how it's struggled in a lot of major metro areas um, recently. And I'd say that the first uh, cause of that was probably primarily the Amazon effect, but then that was accelerated based on what COVID, has shown us
Yeah.
with the restriction of people moving about and their unwillingness to go out or their inability to go out and shop. And so I'm just kind of curious from your standpoint, uh, investing in the markets you're in, have you seen any effect caused by Amazon and/or has COVID affected any of your tenants? And maybe it'd be the first place to start is, uh, I guess the type of tenants you have. Are they primarily anchor tenants?
Yeah, so we typically buy centers that have that are anchored or shadow anchored, as we call it, which means it looks like it's part of the shopping center, but we don't own the real estate for a Target or a Super Walmart. And then our tenancy is typically the TJ Maxx's, Ross Dress for Less, Dick's Sporting Goods, Hobby Lobbies. That's the part of the real estate that we'll own. So junior anchors, but anchored by a bigger box typically. So that's how our shopping centers typically are laid out and look. In terms of Amazon and COVID, similar answers to both, I would say. But more importantly, it would be Amazon, because that's going to continue well beyond COVID. And yeah, we absolutely have fared differently from our friends in the metro market business. I would say it's more lucky than smart. When we started focusing on these smaller markets, it wasn't because of an expectation of an Amazon. Funnily enough, I started my career at Bankers Trust when Jeff Bezos was there at Bankers Trust, and he went on to start Amazon, and I went eventually to invest in the opposite of Amazon, in bricks and mortar. So no expectation in what was coming with e-commerce when we started focusing on these smaller markets. But luckily, because we're in these isolated markets, what our retail relationships, our friends in the retail business tell us is that we are needed so much more. Our physical locations are needed so much more than in the metro markets where there's several of their stores. So let's say Best Buy is an example. Often our Best Buy in our shopping center is the only Best Buy for at least 50 miles. And what they tell us is that their online customers will not be comfortable buying online if they don't have a store that they, in their mind, know that they can return to or go and check it out or ask questions to. So they may be an online customer, but they're much less likely to be an online customer if there isn't a store for 50 miles. So what that allows is for the retailers to really consider our location as a meaningful hub for to enhance their online presence. And then more recently, as these retailers have figured out that their stores need to be almost mini distribution centers, Target's been very public that I think 95% of their online orders are being shipped from their store directly. And that's happening on a major scale, like a Target and a Walmart, but also on a minor scale where the buy online, pick up in store are so meaningful for these retailers that having us in these locations that are far from the next location make us much more important to those retailers. And we've seen that even if our sales performance, which is the number one factor in us buying and keeping owning certain shopping centers, isn't as high as maybe a certain metro market, we know that its relevance is much higher. So that's been a big help for us, and why I think we haven't seen stores close in our portfolio. Now, the Amazon effect on the negative side, which just affects us the same way as metro markets, is any of the retailers that hadn't figured out their strategy to compete with Amazon, which the winning strategy has been their omni-channel marketing, their ability to integrate bricks and mortar with online. The ones that weren't able to figure that out, and Amazon and really COVID also expedited their demise, and their bankruptcies certainly have affected us. Anytime we have a vacancy, that's typically a challenge for us. We have to go and fill it. But our strategy in really owning the best center in a given strong market allows us to mitigate for that and refill that space pretty quickly. I mean, right now we're at our highest occupancy we've been in years. When we did lose tenants to bankruptcies, we've been able to fill their spaces very quickly, and that's been, I think, partly due to our strategy of having this monopolistic position in a given market or trade area.
No, it sounds definitely, you're certainly in demand if you're able to fill the big boxing. I know, like, I grew up back in the Midwest in kind of suburbia of Kansas City.
Oh,
And one of the things that and now I live in Portland, Oregon, but one of the things that I've always been, just as a comparison, is how, like, in the Midwest, the availability of space was like unlimited. And so that a lot of times you had this kind of a leapfrog effect where, you'd have a new suburb, but then there'd be the one that grew beyond that one. And there's almost like a proportional value placed on your property based on how new it was, even though you're moving further and further and further from the core. And I think some of that's kind of is right, or it's recalibrating, and there's kind of a recognition of wanting to be closer to the core in some cases. But what was kind of eye-opening for me was to see these great big huge malls just going dark, and I was like, well, how many malls can you support? I mean, if you keep building a new one further out, people are going to be attracted to that, and you had these big vacant malls. But what in the markets that you're based in, it sounds like, if you're the center for 50 miles, I mean, what kind of a population do you guys look for when you're making an investment? Is there a a target population size for a surrounding area that you guys, or a minimum population size that you
yeah,
look for?
absolutely. We won't look at anything less than 50,000 people in the trade area, but typically we're closer to 100,000 at least. And that's typically our sweet spot.
Got it. On the in those markets, do you find that the cap rates and the return, cash flow return, more, or is it a higher cap? I mean, I would assume it's a higher
Yeah.
cap rate than what you would find in a metro.
Yeah, that's always been part of our attraction and draw is we've, typically been at probably about a 200 basis point spread in cap rate compared to our metro market competition. So where metro markets might have been at 6 caps, we were at 8 caps, and that 200 basis point spread probably remains the same today. We're buying in the 8 cap approximate range for what we've always felt were more stable flows of income than those metro markets, which, due to their competition, just have a lot more potential risk. When you're buying in a metro market, you're often buying a higher rent. When you're buying in one of our markets, you're buying a much lower rent because the real estate, it costs less. So therefore, we can have these retailers operate at a much lower operating expense. So what we're giving up for that, I think, is rent growth in our markets that aren't going to grow as quickly as some of those metro growth areas. We're not going to get the big, huge rent increases that historically some of the metro markets have experienced, but we're very happy to give up that growth for the higher going in yield and the stability of that yield. And as our track record has shown, we've been able to maintain very, very stable current cash flow for ourselves and our investors for many years.
Got it. I want to circle back quick. You'd mentioned something about the omni-channel distribution plan for the successful retailers. And in the beginning, you'd mentioned that the Chase properties had built and done a lot with Kmart. Having been a former Kmart employee while I was in
Oh,
high
wow.
school, and also I worked at Sears, I think, when I was in high school and college. Um, the it always, I mean, it's amazing to me that the company that had the Christmas wish book, that had, basically, they were the retailer, basically was not able to, figure out this omni-channel thing and get basically left in the dust. And I believe, I mean, I thought I saw something where Sears has gone bankrupt. And I thought Sears had acquired Kmart at one point. It's
Yeah,
my history, my retail history is a
that's
little bit
right.
fuzzy, but I think that's what it was.
Yeah.
So I was going to ask you, do you still have any? Is Kmart even a brand? Is it still any of your tenants, or have all those gone? Okay.
So one thing I think we do a good job of is trying to get ahead of when we see a trend going the wrong way. We're typically long-term holders of real estate, but when we're seeing either demographic changes in one of our markets, or retailer issues in a given center that where we don't feel it would be accretive to replace that retailer if they go out of business, we look to sell. So we sold out of our Kmart's, many years ago, and and anything that we had with those as anchors, we tried to get out of. So fortunately, we didn't sit and wait for their demise. In some cases, I have friends that stuck with Kmart's that they really wanted back from the retailer because they were usually paying such low rents that if you were if you could wait it out, if you could wait till they would not want to pay rent anymore, and you could, because those stores were all performing terribly, you could do something with the space that would be considerably accretive compared to the Kmart rent you were getting. That those became wins for many people, but we were able to sell before Kmart was as bad as it was.
Got it. You mentioned you guys are kind of long-term holds. Is the do you guys run a fund, or is it primarily a private, a family fund, or how
Yeah, we started bringing outside capital in through a fund structure, probably 11, 12 years ago. So we currently are in our fourth fund, which we've been typically the biggest investor in the fund, but we have several friends and family, and then friends of friends that have invested with us and been our partners in the same strategy, and that's how we buy our retail today.
Got it. And hold time, what is a typical hold time for you? You mentioned you get out of something if you realize it's going, the future doesn't look bright. Is your hold time forever if not, or
Yeah, that's a great question, because sometimes people ask me, what's the difference in how you invest when you were investing for the single family versus when you started taking outside investors? And that's the biggest difference. It's not that we invest differently, but we had to structure something differently because most investors want to know that there is a defined exit, a time where they're going to get their initial capital back, because they may be thinking like they may be dead, and they want to know when their children will see their money back. things like that. So for our funds, we set up 7-year holds with 3 1-year extension periods. So it's a 7 to 10-year hold, which would have been different than our typical buy great real estate forever, only sell when we see trends moving against us, or for some reason we feel we're not the right operator of that center. Maybe it's too far from us and or too far from the rest of our centers for us to lease it and manage it as well as someone else might be able to. But otherwise, we're really long-term forever holders. But what we do have is the ability then to, if we feel the real estate is great, to buy that real estate along with all of our investors at the end of that fund life, so that we could theoretically continue to hold that asset forever. But it allows for our investors, if they want that liquidity in the 7 to 10-year period, to be able to get have an exit.
Got it. Now, it's always been kind of a, or I should say always, it was kind of an aha moment for me to understand that, and I'm a very small time investor, small residential stuff, but I've always done it. My wife and I have been the capital, and pretty much forever hold, and just kind of understanding how the investors, I mean, if you're going to bring in other capital, you've got to have an exit strategy because they like you said, they want their money back. So just a different structure and just understanding that. So I was looking here. Are you finding in the markets that you are operating in, are there lots of opportunities, or is this kind of a lot of commercial real estate is kind of a fairly close to the vest? If you're a known entity, you're getting the calls of there's properties available, or are you guys out, scouring the market looking for new markets and new opportunities?
Yeah, we're always scouring the markets, but fortunately, one of the benefits of being around for almost 50 years and really being focused on this space is we are known as one of the largest private buyers of smaller market retail. So we typically get that first call when an asset's being marketed, or even when they're not, when a REIT, when a public real estate firm is looking to sell real estate in a secondary tertiary market, we're often getting that call. But we also have our eye on assets that we would love to own for the long term, and we're letting those owners know that we're interested should they decide to sell. So we're constantly scouring the market, and we look at probably thousands of deals a year broadly, and then that gets filtered to hundreds that we spend time on, and then we probably go and look at 20 assets a year or so, and typically transact on 2 to 5 assets a year.
Got it. And in the market you play in, are you typically, like, if there's I don't know if you ever look at any dark properties or not, but is it typically it's repurposed for retail, or have you gotten in anything where you've seen different opportunities, i.e. self-storage or something like that? I've heard, others converting some of the dark retail into, maybe a self-storage kind of thing.
Yeah, repurpose is sort of a hot topic in retail, particularly with malls, and we could talk about malls separately, but for our open air shopping centers, when we see vacancy that's been vacant for a while, it's typically vacant for a reason. Now that was different 10 years ago, 20 years ago, where there were opportunities to do something on a value add basis because of our retail relationships and our expertise in these markets. Today, it's rare. We'll do it. We'll look at certainly when there's 1 box or 2 boxes that we can do something with. But when we see one of these ghost town retail centers, it's typically not something we're going to want to pursue. In terms of repurposing to self-storage, or a use like that, or even, on the more expensive side, multifamily or industrial, you need to be able to own that asset at such a low basis to make it make sense, whether because the self-storage rents are going to be so low, or on the multifamily side, the amount of capital, or industrial, the amount of capital you're going to need to put in is so extreme that uh, it's it's it, it's a lot harder than I think people think, to make that work. So if you can basically get it for free or almost free, I think there's a lot of interesting opportunities to do, and people do. Sometimes you can buy the debt for pennies on the dollar, and you can make something like that work. But outside of that, it's very difficult to make the math work.
Right, right. You mentioned some other assets. Do I understand correctly that you guys are also in some multifamily and industrial properties?
Yeah, we've been probably over the past 5 years diversifying into multifamily and industrial. Um, we're still extremely bullish on retail and the retail that we like, but we're extremely disciplined on what retail will buy. So to broaden our ability to find investments for ourselves and our investors, we've brought in expertise for multifamily and industrial to help us source similar risk reward type properties, stronger, smaller markets. We've bought in outside of St. Louis. We're getting ready to do a smaller market in Florida shortly. That's on the multifamily side. Industrial, we've bought in Ohio a few assets. We've bought in markets outside of Orlando. So we're building that up for those asset classes. We have not started a fund business. We're not at the point where we want to do a blind fund for our investors. We're buying those on a deal by deal basis. We invest, and then we go to our investors and show them the asset and see if they'd like to participate with us. And so far, that's been a really great expansion for us.
Got it. And for those assets, are you entering the same kind of mindset as a forever hold, or is that do you have an exit strategy on those?
Yeah, they really are forever holds. Ideally, I mean, we were faced with that question on this St. Louis asset recently, where we were able to expand the project and raise rents higher than we had expected, and there was and with cap rates continuing to compress, we were faced with one of these this has been a home run, let's take money off the table, which typically isn't really, we're not seeing that drastic of a return change within a couple of years. And we knew for ourselves and our investors, having that great asset and being able to continue cash flow on that great asset was our number one priority. So we chose to refinance. We're still able to take out a lot of our winnings, let's say, from the refinance, but we're going to be able to continue to own an asset that we love and we think will continue to perform for the long term. So yeah, more often than not, we're gonna continue even on those other asset classes to own for the long term and continue good, stable cash flow returns for us and our investors.
Got it. When you speak in industrial, is there a type of industrial that you guys are into, or?
Yeah, I mean, it comes back to the fundamentals of what we like in retail, which is solid credit tenants are the users, or a geography that's going to demand those solid credit tenants. So, the assets we've bought have ranged from a vacant truck terminal that we were able to put a very strong credit public company tenant in for a 10-year lease, to a cold storage facility that we were able to put a very strong credit tenant food distributor in, and we're even expanding that building now because the demand is so strong for high credit tenants in those areas. So I would say choosing assets where we know we're going to have demand from the kind of tenants that we're going to want to work with.
No, that makes sense. Always having a credit where the tenant is preferred is to somebody that's not. Hey, Yoel, if we could, I'd like to shift gears here for a second. As I mentioned to you before we started recording, by day I'm an insurance broker, and I try and work with my clients to assess risk and determine what to do with the risk. And we typically do that in one of three ways. We look to see if we can first avoid the risk. If that's not an option, we look to see if we can minimize the risk. And when neither of those are options, we look to see if we can transfer the risk. And that's what an insurance policy is. I like to ask my guest if they can look at their own situation, their clients, investors, the market, tenants, however you want to frame it. But if you can look at your situation and consider what is the biggest risk. And for clarification, I'm not necessarily looking for an insurance related answer, but if you're willing, I'd like to ask you, Yoel Mayerfeld, what is the biggest risk?
Sure. Well, I'll answer in a couple of ways. And risk, as I mentioned, from how I was trained in my professional life, is really what I'm always first focused on. Whenever we're looking at an opportunity, I'm always spending a lot more time on what can go wrong than what can go right, because capital preservation is our sort of number one goal. I was looking at my calendar yesterday and saw that we had this podcast, and Robbie, who set this up with you, wrote in the notes that one question you like to ask is about risk. I should be prepared, and I happen to have been talking to a friend of mine that's a CEO of a large real estate company, a public REIT, and I said, I'm interested in what I'm going to say about what my largest, what I think the biggest risk in this industry is. What do you think the biggest risk is? And he said, well, for sure, the biggest risk is capital markets freezing up, because whenever that happens, it really puts us in a bind, and to be able to borrow, which we saw certainly after the 2008 recession and during COVID. But for me, that isn't at all what I think of as the biggest risk. And I think part of that is our strategy, which one thing I didn't get into is that we are low leverage borrowers, which I think differentiates us. So even when capital markets are tight, for our lower loan to value needs, usually there's more room for us than for others. Our bankers always tell us they can sleep at night with us better than they can sleep at night with many of their other real estate borrowers. So I just thought that was interesting. I think that would be what a lot of retail real estate or real estate investors in general would say it's the biggest risk. But for us, we're so focused on the real estate and it performing with or without debt. We're really not about the financial engineering part of real estate, which at these low cap rates, I think every real estate investor has had to become somewhat more of a financial engineering trade than a real estate is a real estate grade trade, which is where we really try to stick with. So for us, that wouldn't be it. For us, really I'll answer on the retail side, which has been the bulk of our experience and our investment. The biggest risk is we can't perform well if our tenants don't perform well. So our biggest risk is these retailers not sort of figuring it out. And right now they've been, our portfolio, the sales that tenants report to us are stronger than they've been even pre-COVID, they're figuring out their integration of bricks and mortar and online. So they're doing that well. But the day that they don't, the day that they let competition like Amazon innovate quicker, figure it out in a way that puts them at a disadvantage, that's a big risk to us. We need our tenants to do well. So that's on a more micro to the retail aspect. For more of a macro perspective, as real estate investors generally, which is what we are, I would say it's the risk of the unknown after living through COVID. You mentioned insurance. We have what we feel is really good insurance for our portfolio, and thought of every scenario. We weren't covered for lack of rent during COVID when retailers couldn't pay. So I think the unknown is the biggest risk. So the mitigant, I would say, has been our diversification is sort of like the answer for all kinds of risks for investing. And adding multifamily and industrial was a huge help now for COVID, because while our retailers couldn't pay rent during COVID because their stores were closed, our industrial properties all paid rent, our multifamily properties all paid rent. So that diversification was huge for during that 3-month period of COVID that helped us sleep better at night. Now, even the retail properties, it was very temporary, and it was a stressful few months when those stores were closed. But we deferred the rents for most of our retailers because our lenders allowed us to defer our loan payments. So all worked out fine, but having that diversification was really the mitigant for us globally. And then the diversification even within our retail portfolio of mixed geographies, mixed tenants for different credits, so that when the Ascena brands struggled and Dress Barn closed, it was such a tiny percentage of all of our tenancy that it was very easy to move beyond that, fill some of those Dress Barns, and most of our portfolio continued to thrive. So we were okay. So the answer to mitigating some of these risks that I think about continues to be diversification, which has really helped us.
No, I appreciate you going into that. The clearly diversification makes sense. I think the thing you mentioned about the way you structure your deals to where you're not so heavily leveraged. I don't think a lot of people really realize the risk that they run when they take on a greater leverage position, and hopefully it doesn't bite people. But clearly, history has shown if you get out there too far over your skis, the bank can call back your note, and if you don't have the wherewithal to withstand that, or the ability to find new capital, you could be sunk. So I appreciate you sharing that.
Sure.
Hey, Yoel, where can the listeners go if they would like to learn more or connect with you?
Sure. They can go to either our website, chaseprop.com. They can email me directly, which my email is ymayerfeld@chaseprop.com. Y, M like Mary, A, Y, E, R like Roger, F like Frank, E, L like Larry, D like David @chaseprop.com. Then go to my LinkedIn, Yoel Mayerfeld, and happy to answer any questions or talk to any of your listeners.
Awesome. Yoel, I can't say thanks enough for taking the time to talk today. I've enjoyed it and learned a lot, and hopefully we can do it again soon.
Yeah, thank you. This was great. I really had fun. I appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.